Hello, this is the advisory group's first quarter of 2016 quarterly context webinar. This is Greg Patterson, CEO of the advisory group. These meetings are designed to help clients and friends of the advisory group develop perspective and context regarding financial decisions with respect to markets, the economy, investor behavior, and other factors that may be helpful. So let's get started. As always, we like to remind people to focus on what matters most. Keep an eye towards your goals with regards to short-term and long-term and what's desired versus required. And if you have changes, whether you're a fiduciary or an individual or a family, please let us know so that we can help you develop and adjust planning accordingly. Regarding markets, the first quarter was relatively flat to negative in stock markets. The U.S. market, large cap, was up about 1.4%. The world market overall up about 0.4%. International markets and small cap were negative in the negative 1.5 to negative 3% range. Emerging market stocks were particularly strong for the quarter, coming off some weakness in the last year or so that was driven heavily by China and concerns about China. China market fell about 25% altogether during the year, 14% in July of 2015, and they represent 25% of that market index, so they are the tail that wags that particular market dog on occasion. Bonds were relatively strong for the quarter, up 3% for just one quarter. That exceeds actually the full year projection for bonds, given some of the volatility and the concerns in the market. And the surprise winner for the quarter was international bonds, up 8.3%, heavily driven by strengthening currencies, in particular the yen up 7% and the euro up 5%. For the year, that wasn't enough to make the difference for emerging markets and several equity asset classes, given some of the volatility and the concerns about global growth and slowing global growth, for example, or the concern about the potential slowdown in global growth. In terms of volatility, the VIX index, which is a measurement of overall market volatility, has been relatively calm of late after a period where oil concerns and global growth in China had volatility picking up for a while. During the quarter, it was one of the largest mid-quarter reversals in history, down 10% and then up 12% to have a net effect in the around 1% range. Again, some of the effects, the biggest effects, were the global growth concerns as well as commodities. The Fed decided not to raise rates after doing one small rate hike in the fourth quarter. So it's a continuing extended period of very low rates. The Fed wants to make sure that they aren't going to hamper growth and decrease what might otherwise be needed stimulation to keep a tepid economy moving forward. There are some signs of strength, however, but the Fed wants to be careful not to cool those off. Japan and Sweden went to negative interest rates, interestingly, and Europe also pushed for more stimulative policy with other mechanisms. Oil ended at $38 for the quarter, up from a low of $26. It had bumped around the $26 level for off and on a couple of times, very low considering that it was at $148 in 2008 and about $100 at the end of 2013. GDP fell about 0.2% to 2.2 in terms of forecasts. Unemployment stayed about steady at 5%. Wages, in terms of growth, picked up slightly to 2.3%, and inflation picked up just slightly to 2.3%. If we look at overall economic indicators, again, unemployment has been gradually improving, but now hovering around 5%, which is right about the Fed target. The other major or significant Fed target is inflation, which hovers around 2%, which is around where we are now, but the Fed is still hesitant to increase rates. And the labor force participation rate, as you can see here, has several different factors: cyclical, aging, and other. And other can include people being concerned about the lack of ability to jobs, or the inability to obtain a job. Sometimes people take a break temporarily or permanently. That can push the unemployment rate down artificially a bit as well, so something to keep an eye on. Consumer sentiment is relatively healthy, but cooling off a little bit, given some of these market and economic factors. And the price of oil, as you can see here, has been very volatile the last 4 or 5 years, and at a relatively low level now, a low level not seen since about 2004. The overall 4 bad bears market update is shown here. We can see the 4 worst markets in U.S. history: Great Depression, dot-com crash, oil and financial crisis of the 70s, and then the Great Financial Crisis, shown here in blue. And on an after-inflation basis, its recovery of the Great Recession has been much stronger, and in the last quarter or so, markets have picked up a little bit. But this overall trend of very strong returns coming off the second worst market in history, this overall trend shown here in the gold oval, is not sustainable, and it would be more normal for markets to go a little bit sideways for a while, if not on a bumpy basis, towards the long-term average. And the long-term average, if we start at the bottom of the market, would be reflected by this dotted blue line, and that would take about 3 years to get there. If we don't start quite at the bottom of the financial crisis and draw that average line, then it might take 1 to 2 years to get back to more normal average returns. So don't be surprised if market returns are a little bit weak for a while. That doesn't necessarily mean they'll be significantly negative, but they may be a little bit more flat than usual, and the market projections over the next 10 years are projecting lower than average returns. Overall, required recovery returns in Europe and other developed countries, the overall international developed index, it would take 8.6% return per year to get back to the market peak, given the relatively slower recovery. See how that turns out now that Europe is focusing on more stimulative measures like the U.S. did. The U.S. stimulative measures may have pushed the market above its maybe where it should be, some would say, and that may be why, as I mentioned in the last chart, there may be some reversion to the mean. But those that stuck through that difficult market, as you can see here in the lower left, benefited from cumulative returns now through March in the 250 to 320% range. Sticking with it in difficult times is difficult, but often pays off. In the long run, we can see it's not uncommon to have some flat markets. Mentioned before that we might be in or entering a period of somewhat flat markets for a while. If we look back at whether it's been a world war or some other major crisis somehow related to some of these periods, or at least punctuated within those periods, there are strong markets and sideways markets, and then oftentimes are followed by stronger markets and then sometimes sideways markets. So we'll see exactly what happens next, but just be aware that that's normal. Market valuations, sometimes also helpful to review, while not necessarily great as predictions, can tell us on a relative basis whether markets are fairly over or undervalued. The black dots here within the blue 10-year range show that most markets are a little bit above their 10-year average, which means they're slightly overvalued relative to the recent past. And other measures would suggest something similar, although would suggest that they're not dramatically overvalued, whether it's the Shiller PE or other factors. So if we look at the latest versus the 25-year average, for example, it doesn't suggest dramatic differences. That said, that's a different story than if markets were significantly undervalued, which would suggest more of a rebound environment, and that's something that we would have seen towards the bottom of the global financial crisis. In terms of bonds, with the nervousness about equity markets in the last quarter, that led to strength in bonds, and people sometimes, some investors around the country shift towards safer assets. That led to, again, the 3.03% return for the quarter. So a relatively strong quarter, and that again, if the market just went sideways and had a 0% return for the rest of the year, the market would have already met its full year projected return. If we look at investor behavior factors, mutual fund industry data, cash flows suggest by category, again, this is an updated chart, that people in general over time tend to do the exact opposite of what a disciplined investor would do, and that can damage their returns. Pulling out of cash when stock markets are strong and pumping the money in there, and then when the market crashes, going back to cash, and then getting out of cash when money markets are returning zero and stock markets are picking up strength, and back and forth over time, oftentimes missing much of the recovery, waiting until the recovery or the crash has happened, and then shifting. So there's no crystal ball, and the most important thing for most long-term investors is to have a strategy you can live with, adjust it gradually over time based on your needs, not based on emotional concerns. Our quality thermometer for the quarter is surprisingly consistently green. At one level, not surprising given the volatility in the markets. The green boxes here indicate when higher quality stocks have outperformed lower quality stocks, and the numbers inside these boxes show the percentage that high quality outperformed more speculative stocks. And this is reflective of a period of nervousness where the higher quality stocks tend to do better. Portfolios we build have a combination of both high and low quality stocks with a little bit of a bias towards high quality stocks, which prevents or creates a little bit more downside protection in difficult times, and while still obtaining long-term average stock returns in the long run. You can see the overall pattern of quality versus low quality back and forth over time. Again, many markets are cyclical. Speaking of cyclicality, there are a number of market factors or patterns that are worth talking about. We'll highlight two here. Value versus growth. Value stocks tend to be underpriced stocks. Investment managers or markets that focus on that type of stock, whereas growth investment managers or mutual funds focus on higher earnings growth, higher growth rate stocks. And you can see that those tend to take turns over time, back and forth. For a while now, value's been out of favor, but that seems to be switching, heading the other way. It's impossible to predict exactly when that will happen, but that is just a reminder of the cyclicality of markets. Similarly, in the bottom chart here, you can see the U.S. market measured by the Russell 3000, which includes both large cap and small cap, versus the international developed index that have also taken turns over time. Currently, international is relatively out of favor, but there are patterns where that happens, and then over time that switches back. So it's a reminder not to give up on what's ever out of favor, because that oftentimes is where the most reward lies in the next part of the market cycle. The value-added reminder for this quarter is in rebalancing. It's a study that shows that if someone starts with a 60-40 stock bond allocation, if they just did a buy and hold strategy and did not rebalance, they would end up with 73% stocks and 27% bonds 20 years later. In other words, higher stocks, higher risk, but end up actually with a lower return and higher standard deviation or higher risk than a portfolio that is regularly rebalanced back to 60-40. The rebalanced portfolio has a slightly higher return but lower risk, so it's a double win. Just a reminder of something that is conducted behind the scenes for our clients to help add value and reduce risk. In terms of rules and regulations, the big news for the quarter, although it's really during the second quarter, not the first quarter, was the fiduciary rule that came out from the DOL, making it, quote unquote, the law that all financial providers. There are two big caveats to that. However, the first is that there are still loopholes for brokerage firms and others that do not normally accept fiduciary status to avoid that level of responsibility and to continue to operate relatively in the status quo. The advisor group, by the way, began accepting fiduciary status almost 3 decades ago to be absolutely and entirely aligned with client interests without any conflicts of interest. And so you can rest assured that you're well supported in that regard and don't have to worry about whether or not you've read the fine print of a loophole. The other element for the fiduciary rule is that it does not apply to taxable accounts. It doesn't apply outside of IRA and retirement plan accounts, generally speaking. So that's an element there. The MyRA program is a government program. Quick summary here, and then you can review the details, is that it's basically a lot like a Roth IRA, same contribution limits and so forth. You can hold up to maximum of $15,000 or hold it for 30 years, whichever comes first. There's really no risk of losing money, but the dilemma is that the investments are only in U.S. Treasuries, which means that you may or may not even beat inflation. So it's not really a great long-term investment. However, it can be helpful for people who just want to set small amounts of money aside and really do have a place for cash-like investments rather than a long-term strategy. But it really is also more applicable to, in our case, cases of our clients, mostly maybe kids or relatives that have earnings under $131,000 or $193,000. That's where it's capped out. There's some other numbers on the sliding scale, but it's just like a Roth IRA functionally from the eligibility standpoint. For fiduciaries, again, the fiduciary rule is relevant. Talked about that a moment ago. There's a April 30th deadline for many plans to execute their Pension Protection Act restatements, and in the 401k space, the IRS now permits many types of mid-year amendments to safe harbor plans that wasn't possible before in that same way. And those are really the high-level retirement plan rules and reminders. For foundations and endowments, the fiduciary rule does not apply. So if you know other organizations that are being served by an entity that does not accept fiduciary status in writing like the advisory group does, you can help them by helping them understand that they might be better served by someone who would agree in writing to bind themselves to only acting in your best interest or your best interest of the foundation or the endowment. So thank you for attending today. We're always interested in getting your feedback and understanding how we can do better in supporting you and helping you achieve your goals and objectives. And if you know other entities, whether they're 401k, other types of retirement plans, personal wealth clients, foundations and endowments in the size ranges shown here. And then a number of our clients are using our relatively new Wealth Step program for their kids or relatives that have personal accounts under $1 million in size. And we're currently in the process of developing an online advice tool that should be available relatively soon in the coming months. And you'll be hearing announcements about that. That Wealth Step program is also has an overlay element to the 401k plans that we build so that 401k plan participants can receive online advice as well in a way that's not currently available in the industry. So those are exciting developments towards us helping people achieve their goals and their dreams, and that's what we love to do. Thank you very much, and we look forward to hearing from you soon.